Hey everyone, this is chapter 8 from Trading Price Action Trends for the BPA project that I'm working on. This chapter is about the importance of the close of the bar. And just as a reminder, this is all Al Brooks' content from his books in the Trading Price Action series. This is the first book, Trading Price Action Trends. So it's all his content, and it's just my interpretation and analysis of it based on how I've experienced it in my trading and kind of combining it with things that he's mentioned in his other works and in his trading room. So I hope you find it useful. If you have any questions or if you have a different interpretation of it, happy to discuss if you leave in the comments. So one of the main reasons that Al says to wait for the close of the bar is because the close offers a lot of information about the bar itself. He doesn't say this explicitly in this chapter, but he's mentioned it before that the four main components of the bar, of a bar's strength and bar's information, is the open, high, the low, and the close. And if you miss the close, then you're missing a very large portion of the information that the bar is telling you. Al often refers to signs of strength based on the close of the bar. So if the bar closes near the high of the bar versus in the middle of the bar, and does this current bar close above the prior bar's high? Does it close above the prior bar's close? Those are all important factors, and they're all based on the close of the bar. So if you don't wait for the close of the bar, then you miss all of those key pieces of information. And the next point that Al makes, which is stated explicitly in the book, is that a bar's appearance may change and often does change in the last few moments of the bar, and that's relative to the time frame. So the end of any bar becomes a fight that determines the shape of that bar. So for a 1 minute bar, it would be the last few seconds of a 1 minute bar. It might be the last minute of a 5 minute bar, be the last 1 or 2 5 minute bars of the hour. It'd be the last day of the week and the last week or day of the month. And that's why Al often says that on Fridays, weekly support and resistance are important, because Friday's the last day of the week, and it's often at the end of the bar that determines a key close for that bar. So on Friday, it would be important to see if the bulls can close above the prior week's high, if the bulls can close above a prior week's resistance or a prior resistance level. That's often determined on a Friday, which is right before the bar closes. And the same is true for the monthly bar. Al often says that the last day of the month, and he's often watching the last week of the month to see how that monthly bar is going to close, because that close is important, and the close is often determined in the last few moments of that bar, and that's relative to the time frame. So last few moments of a monthly bar could be the last week of the month or the last day of the month. The final major point that Al brings up about why it's important to wait for the close of the bar and to analyze the closes of the bars is because institutions use line charts. And so if they're using line charts to place trades and to analyze the market, then they're only using the closes of the bars to make decisions. And Al often says to do what the institutions are doing. And if the institutions are using the closes of the bars, then retail traders should do that as well. The next main point that Al makes about waiting for the bar to close is that the costs in general outweigh the benefits. And so I've kind of broken this down to 3 separate sections: entries, exits, and profit taking. For entries, Al says that sometimes traders will try to enter before the bar closes if the market's racing up, or if the signal bar looks good 10 seconds before it closes, they might enter early to make sure that doesn't get away from them. And in some cases, they'll get a 1 or 2 tick discount, and they'll make an extra 1 or 2 ticks when the trade works out. But Al argues that many times, because the shape of the bar changes in the last few moments, they may enter a trade early only to have the shape of the bar change drastically in the last 10 seconds, and now they're trapped into a trade that is no longer valid. So a trader might make an extra 1 or 2 ticks sometimes by entering early, but if the signal changes, which it often does, in the last 5 to 10 seconds of a 5 minute bar, then they'll be trapped into a bad trade, and they'll lose more on the ones that don't work out than they'll make on the 1 or 2 extra ticks they make on the winning trades. The second argument Al makes about not entering before the bar closes is that sometimes it is useful to do it, and sometimes it's not. But in the process of trying to make that decision, it increases decision fatigue. So Al says there are so many decisions to make when entering a trade that adding this extra decision of, is this a good time to enter before the bar closes, is just not worth it. One important caveat here is that Al typically speaks to swing traders, and in this case, it's specifically for traders who are using a signal bar as their main piece of as their main signal to enter. So, for example, there are many times in a room where Al will say, we have three strong bull bars in a good context. It's buy at the market, buy for any reason, buy a one tick pullback, buy a two tick pullback. It doesn't matter. Just get long in any way you want. In those kinds of situations, the probabilities are already set up for more upside, for a second leg up. So it doesn't really matter if you enter now or enter it with a two or three tick pullback. It's just important to get long. That's different than a situation where the setup is determined by how this one signal bar looks. And if the signal bar doesn't look perfect, then it's not worth taking. Whereas in a buy the close market or a clearly always in long market, it doesn't really matter what that specific bar looks like, because overall we're probably going to get a second leg up and more upside. So it's not as important to wait to see what that exact bar looks like if you're going to enter for any reason anyways. So this is mainly for traders whose decision is based on what this one bar looks like. The next section, where the costs outweigh the benefits, is for exits. And Al mentions that you can trap yourself out of a good trade by exiting based on a lower time frame signal. So you're trading on the 5-minute chart and it's a strong bull trend or a strong buy the close rally, but then you go to the 2-minute chart and exit below a bear bar. Every bear bar in a bull trend is a pullback or part of a pullback. And if you're managing a trade based on a lower time frame, you have to decipher how every bear bar fits into the overall picture of the trend on that lower time frame. And this will cause premature exits because most traders have a hard time analyzing one chart well. And it's much more difficult to read and analyze two time frames, especially with one being faster than your normal trading time frame. The third overall section here is profit taking. By waiting for the bar to close, you can see signs of strength and determine your management based on how the trade is working for you. So if your entry bar and your follow-through bar are closing on their highs and above the highs of prior bars, then you may hold more of your position for a swing. So Al says, by waiting for those bars to close, you can then determine how much to scale out. Maybe you hold the entire position for a swing because of how strong it's looking and the context is good. Or maybe you were initially going to scale out half, but instead you only scale out a third or a quarter because you see these signs of strength because you gave it a chance to develop and see how the bar was closing instead of exiting halfway through a bar. Again, I think it's important to mention that these kinds of criteria are mainly important for swing traders who are already going to be waiting for a trade to develop. So if you're waiting for a trade to develop, it's important to see how the bar closes before making a decision because it'll give you information about how to manage that trade. But there are also exceptions to this rule, and Al's an example of that because Al typically will buy and scalp in a buy the close rally and won't necessarily hold. Now, if the context is good, he has mentioned that if the context is good for a swing and is starting to form a swing, that he'll maybe swing half his position or he'll swing all of it. But most times when it's not a clear swing, Al's usually buying and scalping. So he'll buy the 47 close and scalp, and then see 48 close on its high, buy 48 and scalp, buy 49 and scalp, and then 50 doesn't trigger. So he's usually buying above bars after they close. So he still is waiting for the bar to close, but he's not waiting to see the bars close and then hoping for a swing. He's usually only swing trading once has clearly become a swing. So once you see 48, 49, 50, we're probably going to get a second leg up, and he'd be more likely to swing that. And that's my experience from his room, from what he said in the room for many years, that he's only swing trading when it's clearly a swing, but he's not buying 44 or 45 hoping that it becomes a swing. He's waiting for it to clearly develop. So for an experienced trader like Al or someone who's buying and scalping, they're not going to buy and hope that it becomes a swing trade, but they're going to wait for it to become obviously a swing trade first and then swing. That makes it a little bit more difficult because now a trader in this move here, for a swing trader who buys 45 or 46, they're making one decision, 46, and then they see 47, 48, and they know that this is probably becoming a swing, and they can hold. Whereas someone like Al or a scalper will have to make 5 decisions here. They'll buy and scalp, buy and scalp, buy and scalp, all the way up. And every time you decide to do that, it's an extra decision that has to be made. So it's mainly for experienced traders. And that's why when Al says it, he's speaking more to beginner and intermediate traders who are mainly trying to swing trade, because that's the right attitude, to wait for the trade to develop, see what the bars look like, and then determine how to manage based on the signs of strength. And so, like I mentioned here, for a trader who buys 46 or 47 for a swing, and they see 48, now we have 4 consecutive bull bars. and it increases the likelihood of a decent sized swing trade. And so a trader might, instead of scaling out half or a large portion of their trade, they may decide to only scale out a quarter and leave the rest for a swing trade because it looks like it's clearly forming a swing, 4 strong bull bars in a good context. Same situation here for a trader who buys above 11 or 12 and they see 14, 15. Now we have 5 consecutive bull bars and a lot of them are closing on their highs or near their highs. A trader will be more likely to hold more of their position for a swing. And if they see 16, 17, now they're much more likely to hold, possibly for a strong bull trend day. And that leads to the second point of profit taking, which is by waiting for the bar to close, you can take advantage of favorable surprises. So in this case, by waiting to see how 16 closes, seeing that it closed above yesterday's high of day, and then waiting for 17 to close, instead of just taking profits at an arbitrary number above the high of yesterday, or an arbitrary number above your entry, by waiting to see the bars close, you can see that the strength is building. And so 14, 15, 16, 17 all growing in size, you only get that information by waiting for the bar to close and see how big the bar gets. And when you wait for 17 to close and you see all this extra information, now you know that you're in pretty good standing to hold for a larger swing for the day. So by waiting for the bars to close and develop, you get the benefit of seeing the signs of strength that you wouldn't otherwise see. Now, if you just exit for any reason, maybe at the high of 7 or at the high of yesterday, you can always get back in. But from my experience, it's always harder to get back in once you've just exited than if you've already committed to holding and waiting for a strong signal to exit or waiting for something to disprove your thesis. Whereas if you're just constantly entering and exiting, it's I think in the long run, scalping that way with a lot of experience might make the most sense. But for most traders who aren't at that level, which includes me, once you have the mindset to wait for your thesis to be invalidated, you're much more likely and much more willing to give the trade a little bit of room to develop. So another form of favorable surprise is at the end of a buy the close rally, so an exhaustion bar. So here we have buy the close rally from 67, 68, 69, 70, 71. For a trader who buys a close of 67 or 68 and just waits, they're waiting for the closes of the bars to see how they form and then make a decision based on what is more likely to happen next. So a doji late in a buy the close rally is often a final flag that leads to one more leg. And by waiting for the next bar to finish, you see that you get an exhaustion bar. So instead of just expecting one more small leg and exiting with 1 point or 2 points, knowing that there's one more leg left and letting the bar close, you can maximize that by catching a surprise here on bar 73. Same is true here. If you buy the close rally, you wait for the bars to form, and when you see 42, a doji, late in a buy the close rally, you know there's probably one leg left, or possibly 1 or 2 bars left. And when you see a bigger bar, 43, you can exit. It's not a clear bigger bar, but it's definitely bigger than the last 4 or 5 bars. And that's a good enough reason to exit based on exhaustion, betting that we're going to pull back for a few legs before getting trend resumption up. And same is true here. A lot of bull bars in a row. If you're holding, you wait for some clear signs of exhaustion, and you can only do that if you wait for the bar to close. So in this case, it would be on the close of 20 or the close of 21, knowing that we're probably going to pull back for a couple legs before getting trend resumption up. One more benefit of waiting for the bar to close is that the close of the bar can often indicate when a leg is complete, an individual leg is complete. It also gives us a sense of the rhythm of the market. And these two factors can help us maximize profits, avoid unfavorable surprises, and also refine entries. This isn't something that Al talks about in this chapter, but he's mentioned it many times in his room over the years. And this is also something that Ali talks about a lot. It's a principle that has helped me kind of get a sense of the market structure. And so I wanted to share it here in case it helps anyone else here as well. So this is a test of the moving average and then a rally in a tight channel. Then we get a double bottom bull flag followed by a breakout above the moving average and doji follow through. This is a 5-minute chart, but this big bull bar here on the 1-minute chart is 5 1-minute bars up and then 5 1-minute bars sideways. From chapter 2, Al talks about how a doji ends a climax or a doji ends a leg. So in this case, we had the leg up and then pause. So this leg was completed in 1 5-minute bar. And so it gives us an idea of how much distance is covered in a typical 5-minute bar and how long the legs may last if this rhythm continues, and it often does. So here we have a second leg up. And so without seeing this doji, just by waiting for the bar to close, we see that this could be a potential second leg from this impulse up. So impulse, pause, and then second leg. Now this is not a clear drop in momentum. It's a similar size as bar one. And so if we get a sideways correction here, we may get one more leg up. But by waiting for the bar to close, this could also be a surprise. It could be a big breakout that ends up here, similar to this chart. So we have impulse, pause, and then the second leg covered more distance in the same amount of time. So this took 5 minutes. This also took 5 minutes, but it covered more distance. So it's a little bit more of a surprise. And so by waiting for the bar to close, we get more information that this is probably going to have a second leg up of its own, but it also might start a channel of its own. So we have 1, pause, and then 2, pause, 3, and actually ended up having a larger channel after this big spike. But this surprise gives us more information, and by being long during the surprise and waiting for the bar to close, it gives us information of what to expect over the next 2 to 5 bars. That's the same situation here. We have a bull bar and then a pause. So this pause ends this leg. So leg 1, pause, leg 2, and we see that in the same unit time in 5 minutes, we actually covered more distance here. So this is a possible surprise. Now instead of getting a doji after this bigger bull bar, we actually get another bigger bull bar. So this is actually accelerating up. And by waiting for these bars to close, we get more information about the size of the legs. So in this case, we had a 1 bar leg, pause, but then this one we have 2 bars as a leg. So that's actually showing acceleration, and that it might start its own channel or might become its own spike for a larger channel or a second leg up. So this is useful for maximizing profits by seeing the rhythm of the market, and also by giving the bar a chance to close to see how much distance is covered in that same amount of time, to see the magnitude of the legs. It's also useful for refining entries and avoiding unfavorable surprises when entering with limit orders. So for example, here we have a bull spike and we're expecting a second leg up. We have a tail here and then an inside bar and then a bear breakout. So this bear breakout and pause might get its own second leg down, and we know that this leg lasted 5 minutes. So one way to do this is just enter with a limit order, maybe below the bull bar, maybe at this breakout point, or maybe you enter at some distance below this inside bar low. So maybe you buy 2 points lower and 4 points lower. Those are different options. A conservative option is to say, well, this leg lasted 5 minutes, and then we have a pause. We have an end of this climax. We know that this is probably going to get a second leg of its own. So by waiting for this bar to close, we get a sense of how large the leg is. Did this leg become a surprise bar down? Was it a smaller leg? Was it an equal size leg? By waiting for the close of the bar, we get an idea of leg completion. So this leg lasted 5 minutes, pause, then this leg lasted 5 minutes, and it's about the same size as this one. So this might be a completed parabolic wedge, might be a completed structure for resumption up. Same here. We have a bull spike, we're expecting a second leg up, and we get a bear breakout on 12, pause 13. And so we can either enter with the limit order somewhere below 11, maybe 1 or 2 points below, or we can expect a second leg from this to possibly last 5 minutes. And when this bar closes, when 14 closes, it gives us a sense that the second leg may be complete. And so instead of entering with a limit order at an arbitrary price or at some breakout point, by understanding the structure and the rhythm, we get breakout, pause, breakout, and that might be the end of this pullback for trend resumption up. Now in this case, this is a tight channel down. It needed a second leg, but by buying that close, betting that it's 2 legs down, we're getting a pretty decent price and avoiding the surprise that this could collapse all the way down. So we're getting a sense of the second leg being complete and also not getting caught in a surprise where this accelerates down. So here's the bear case. We have a bear spike down, expecting a second leg down. We have a micro double bottom. This leg lasts 1 bar and gets a pause right after. So the second leg after this might also last 1 bar. And so instead of selling this high or selling this open, we can wait for the bar to close. And that's also a more conservative approach. You may miss the trade, but it also gives you more information so that this doesn't just completely accelerate up against you. You get an idea of the second leg may be complete with this bar closing, and you can sell that close instead. This also happens to be at the high of this bar, which is a good location overall to be selling. Same concept here. We have a breakout, doji pause, and there are many reasons to sell up here, but if you wait to see what happens over the next 5 minutes and wait for this bar to close, we see that it's an equivalent second leg from this. It's not surprisingly big, so it's a reasonable sell to close or looking to sell in this area. But by waiting for the bar to close, we don't get caught in a surprise against us, and we also get more confirmation that the second leg is complete after this surprise. So here's an example where waiting for the bar to close and waiting for second leg completion before entering a short here would actually show you a surprise bar and would give you an opportunity to get a better price and refine your entry. So here we have a leg down, double top bear flag, and then a stronger second leg down. You can also argue that this is a wedge, but this looks strong enough that you may be looking for a second leg sideways to down. And you're waiting for the bulls to fail and looking for an area to sell. Once you see micro double bottom here and then bull bar 19 pause, you may be expecting a second leg up for a wedge. And so you can wait for this bar with the white arrow to close to see the completion of that second leg. In this case, we got a surprise bar. So because we have a surprise, but you're still expecting a second leg sideways from this, you might wait, instead of selling right now, you might wait for this surprise bar to get its own second leg, which we got on 24, which is the bar with the green arrow above it. So here, by waiting for the bar to close and seeing what the bulls are able to accomplish, and in this case, they got a bar that traveled a further distance in the same amount of time as the first leg. It's probably a surprise, probably will get a second leg of its own. By waiting for that and then seeing 24 fade at the moving average, 24 is this bar right here with the tail on top with the green arrow above it. Seeing it fail at the moving average, being a parabolic wedge and a third leg up, that's a better sell at the moving average or sell at the close than selling somewhere here without seeing this bar close as a surprise. Now, there are many ways to structure this. You may not be looking to sell at all. You may be selling half here and then waiting for confirmation to sell the other half. There are many ways to structure the trade, but it's just the idea that waiting for the bars to close gives you a little bit more information about what to expect over the next 2 to 5 bars. And so you can see that instead of selling this close or selling somewhere here at the breakout point, you'd get a much better price by waiting to see how the bars close and get the expectation for the next few bars, and knowing that a second leg up from this bar with the white arrow is likely. And so you may wait a little bit and see the bulls fail again before selling. So that's chapter 8. A little bit of extra stuff at the end. I hope it was clear. I tried my best to explain it as clearly as possible. If it wasn't clear, if you have any questions, comments, feedback, or if you just see it differently than I do, I'm happy to discuss in the comments. But I hope overall it was helpful, and I'll see you all in the next one.